Germany is facing a critical juncture. Chancellor-designate Friedrich Merz has put forth a bold proposal to lift Germany's debt brake. This constitutional rule, implemented in 2009, limits the country's structural budget deficit. Merz aims to use this newfound financial flexibility to bolster Germany's military and invest in critical infrastructure. He's talking big bucks, folks, an extra 1% of GDP annually for defense, which translates to a cool 50 billion euros. And hold on to your hats, because he's also proposing a whopping 500 billion euro infrastructure fund. This is no small potatoes, people. Germany, known for its fiscal discipline, is contemplating a major shift in policy. But why now? Why is Merz so keen on loosening the purse strings? Well, as they say, follow the money. Germany has a long-standing tradition of fiscal conservatism. They like their budgets balanced, their books in order, and their debts minimal. For decades, Germany has maintained a low debt-to-GDP ratio, significantly lower than their European counterparts like France and Italy. It's like the Germany economy is the responsible friend in the group who always pays their bills on time. This aversion to debt is deeply rooted in German history. Remember hyperinflation in the Weimar Republic? Yeah, not a fun time. So they implemented the debt brake in 2009 to prevent history from repeating itself. This rule was like a financial seatbelt, keeping their spending in check. But like any rule, there are exceptions. The debt brake has been temporarily suspended before. Remember the COVID-19 pandemic? Yeah, that threw a wrench in everyone's budget plans. Germany, like many countries, had to loosen the purse strings to provide relief and support their economy. And then came the war in Ukraine, requiring even more spending. But Merz's proposal is different. It's not about dealing with an immediate crisis. It's about making long-term investments in defense and infrastructure. And that's where things get tricky. To amend the constitution and remove the debt brake, Merz needs a two-thirds majority in the Bundestag. And guess what? He doesn't have the numbers. Lifting the debt brake is like driving a car without a speed limit. It might feel exhilarating at first, but it comes with risks. Economists are divided. Some argue that Germany needs to invest to remain competitive and address long-term challenges. Others warn of potential inflation, rising interest rates, and market instability. The bond market has already reacted, with German bond yields shooting up like a rocket. This means borrowing just got more expensive, not just for Germany, but for other countries too. And then there's the issue of resource scarcity. Europe is already facing shortages, and increased spending could exacerbate the problem, leading to even higher prices. So, is Merz's plan a stroke of genius or a recipe for disaster? Only time will tell. But one thing's for sure, folks, it's going to be a bumpy ride.